as you're going through your commercial contracts and through those negotiations, one of the gotchas that comes at you much later on in the life cycle is having a termination for convenience in your contract. Investors want to underwrite revenue that is committed, revenue that is recurring, and by definition, when you have a termination for convenience, even it's with what they call a backdoor termination for convenience, which is, if the customer has business changes that require it to terminate, it can, then the value of that contract gets discounted from your top line. So something to be very careful about in the early days.
And try to not have that.
If you need to have it first or second customer because you need to get someone going and you need to start getting that momentum, there are gives that you give. But over time, that should not be status quo.
I just want to thank you so much, Michaela, for being with us today.
Thanks for having me.
So I've known you as long as I've known myself at Workbench, because your husband, your significant other, is my co-founder, Jonathan Lehr. And I say this truthfully, like, you are my second co-founder, right? Like, you've been with us really through everything. And anytime I've ever talked to John, I know you're like either sitting next to him or you're behind him on the Zoom.
Likely
or
behind
you're also
him,
in the car with him. And I just can't say enough, like, how grateful I am to you for just being the best partner to me.
And
John,
that's so touching.
really?
I mean, it's been so fun watching you guys on this journey over the course of the last, it's been more than a decade. It's been
12 years.
12, thank you. It's as long as John and I've been married, and I always forget the number. Don't tell him that. Should we record it?
It's been a long ass time. But the thing I do want to call out is, again, I've seen you in so many, obviously, roles and times and experiences and scenarios, and it's always been incredible. And you're one of the most impressive women I know, given the work you're leading in finance and as a CFO. But the time I will just call out that I saw you just fucking shine was 2 years ago at the Primary Summit, or the event that you and I both spoke at. You gave a keynote on the topic of P&L fluency. And when I say you were up there on stage, like, the lights were shining on you. There was like 100 women in the room, and you just freaking dominated. And when I say the number of women weren't just like scribbling notes, raising their hands, they were captivated, like straight up mesmerized. Like, you were like the Taylor Swift of P&L fluency, said no one ever. And I just like,
the tallest midget. I
just truly am like, think back to that moment. I was like, one, so proud of you. I was so impressed. And I was like, if I ever start a podcast one day, Michaela's going to come on and we're going to run that back. We're going to like get into all of that because it was just so awesome to see. So I want to thank you for being with us at the drafting table together.
That is so touching, Jess. And, the kudos are like way, way inflated, but thank you. P&L fluency. One of the jokes that I made when I was asked to kind of give that talk was, how much do I enjoy watching executive women take naps? That's what you expect. When you have an hour-long P&L session, that's a lot. But what's really interesting is that I really think people want to understand the financial side of the business. It's just very difficult to start to ask the right questions and can be intimidating.
Absolutely.
And so in making it a little more accessible, I think that's when women got excited in that particular event. So anyways, I'm glad that it
more
went
to
off
come
well.
in this episode, right? Well, so again, the question I ask every guest on this pod is, what's the one thing you think founders should know how to do before they start a company?
There's a few things that come to mind, and in no particular order, I'll start to list them, and we can talk about whichever ones are the most interesting. And not all of them are necessarily, specifically financial things, although I think that plays a part in it. First is obviously building something that you have great conviction in, that you think is really going to sell, right? It's going to be a wonderful thing, and it's actually going to get monetized. And then the next part is, so there's that sort of, I want to say like the product market fit part, which we'll talk about at some point, which is, creating something that people actually want to buy. But then the second part is understanding that the company is going to grow and evolve, and there's going to be phases. And there's phases in the company, and there's also phases in you as a founder and CEO, and how that changes over time. And having the humility to know that going from one phase to the other means having to change, and change can be hard. So I think it's a very interesting evolutionary process with just being open to it and being open to bringing subject matter experts to the table that will help you as you are going through that journey to say, hey, here's the stage that you're at now. Here's what you need to understand. I think that that's a really interesting piece that I think is easy to say and difficult to actually grasp for a lot of founders.
100%, right? And, I think at every stage, founders have to deal with so many things and learn so many things. And, a huge premise of the show is that, you are not expected to know everything, obviously, before you start a company. It's just absolutely no way, right? But, the reason I was excited to really have you come on was to say, I've worked with so many founders now, right, over the last decade. And many of them are very, very well versed in SaaS metrics and finance, but a lot are not. Just like straight up, they're just not. And I don't think it's their fault. I think very few people go to SaaS school, right? And so one of the things I would even ask you, right, is specifically, again, what do you think is that one financial SaaS thing like a founder needs to know? Like, is it that you think they need to know how to build a model? Is it that they should read a model? Is it just to your point, they should be open to knowing, hey, this is way above, where I'm at. I need to bring in a VP of finance.
Yeah. So I think it's a matter of saying or understanding your company as a utility function. And, forgive the analogy, I was an econ major and that was what we spend all our time on. But there's a lot of different variables in the business, right? And I'm going to say things in like econ speak that everyone knows qualitatively to be true. There's a lot of different variables in the business. There's a lot of different levers that you push and pull. And you, as a founder, this from a high level. Treat the finance partner as the quantitative reflection of exactly that utility function. So where you're thinking, hey, do I put my next dollar into sales and marketing or into engineering? There is inherently some numbers speak underneath that. And so, understanding what that relationship could and should look like is, I think, something that could be really useful for founders once they reach the stage where they need to care about it.
Yeah,
and we'll talk about that part as well.
Yeah, I think we can get into all of that of when do you bring on this VP of finance, right? And generally at seed stage, it's way too early.
Definitely not.
Right? But I guess we fast forward, even at pre-Series A, at Series A, that's at least when we generally see as a rough framework to that'd be a good time. Just to go back to your point though about what are the levers or that you can be pushing and pulling on. I think that's a really interesting part within finance that again, you can build a great model, right? But then you need to know what are those inputs and those are the levers.
That's the thing that matters.
That really matters, right? And not to oversimplify things, but I do think there was a period of time when founders thought, well, if I just have more venture funding, I can hire more salespeople, and therefore I will have more revenue.
Exactly.
Duh.
And then you get more company. Yeah, right? That's exactly it.
I mean, can we use that very specific example of even breaking down like sales and marketing, right? Like, what are the things you've seen in your time as a CFO that you're like, okay, these are the levers that people maybe know of, but under the hood of it, these are the different drivers.
Yeah, I mean, so first things first, right? When fundraising is easy, you throw a lot into sales and marketing and you say, hey, I'll always be able to kind of get to the next round. And if it's not going to be venture funding, I'll figure out some sort of structured way to finance the business. Obviously, things have changed now. And I think that it's painful, but I do think it's healthy for the broader ecosystem to understand that you have to look at the fundamentals of your business and make sure that it's healthy, kind of as you're growing and scaling it. But, specific to your point on sales and marketing, one of the things under the hood that I think is really interesting that a lot of folks in those roles don't think about is how your gross margin will impact your sales and marketing efficiency numbers. So what does that mean specifically? We all know about the different components. We can even talk about the components of what go into the sort of sales and marketing spend, right? But one of the things that's interesting is that all of those, or many of those metrics that you care about, take like a CAC payback, right? It is margin weighted. So what does that mean? So it means that what the investors are trying to understand is we're investing in this sort of sales and marketing spend. And then we want to understand how does that translate into something that is useful for investing into the business. And so when you're looking at your top line and you're looking at your kind of sales numbers, what you want to understand is not just what is happening at the top line, because that is the number of customers you have. That's the scale of your business. It's a really, really important metric. I don't want to downplay it. But then there's the cost of your product. Just running it, just keeping the lights on, right? And that's usually the money you give to AWS or GCP or Azure, whoever you're using. That's, certain parts of your services organization. And so then you get a percentage of that dollar that you're actually able to then invest back into the business. And then later on, much, much later on, when you're closer to public company time or at public company time, that's what could eventually flow into the profit margin, the bottom line, and back to the retail investors. So understanding, am I selling a dollar in a sustainable way, or am I selling a dollar for 99 cents? That's oversimplifying it. But that's a sort of non-obvious thing under the hood that goes a bit more into finance land than many sales and marketers are generally going. But it matters.
Totally. Yeah, I mean, I think about this a lot. Again, I think perhaps founders think about it, okay, there's sales and marketing, and I know I have to pay my reps and we give them commission and they have to bring in this amount of quota, right? And then the other side of it is there's margins, and I know I have to pay, AWS this much for compute, et cetera, and this is how much but I think to your point, that it's together, you have to look at those numbers together.
You have to look at those pieces together to understand what you're actually getting for what you're selling.
Exactly.
There is one other piece on a slightly related note that I think is really interesting to talk about. As you talk about sales in the top line, generally in software you have your product revenue, and then you have your services revenue. So you kind of have a bit of both, and you see a lot of conversations around how should we think about services. Our service is recurring. That gets into this sort of ARR conversation. So another thing to think about when selling is what percentage of my contracts are in services and what percentage are in my core product, which is really important. And the reason why that's important, there's actually two reasons. The first reason is your product, going back to margin, your product is more lucrative on a dollar per dollar basis because you have generally, it's a higher part of your contract. Call it a $100,000 contract. It's like $80,000. Call it into your product, $20,000 maybe into services. Depends on the specifics of your business. The cost of running that product on a percentage basis is generally higher. So you're going to get something, hopefully over time, closer to the 70, 80%, maybe the 90% range. Yeah. Services requires humans. Humans are expensive. And therefore, the margin on services is also much lower. If it's positive, that's great. Usually, it's kind of zero or negative. And so that's the first thing that you look at. How much product revenue am I getting for my sales and marketing investments is something that I would keep an eye on. And the second is, much later, when you think about the monetization of your company and going through, call it an M&A transaction or even going through IPO, there are conversations around, well, should I include services in ARR? Or actually, when you're going to IPO, they don't really look at ARR. But for an M&A, they'll be looking at your recurring revenue streams, and they'll saying, should I even include services? And there are companies where that's just been discounted off of the top line, and the purchase price is, it's a multiple on the product part.
Right, not the services.
So that's just something I would keep a very close eye on as you're thinking through what you're actually bringing in from the sales and marketing side.
Yeah.
What actually is valuable to the company.
Totally. I mean, and even going back to the last point, right? I was actually just catching up with a founder yesterday, and one of the things he had said, he's been a founder for 10 years, and he said one of the things that he looks back and he thinks they could have done a better job was recognizing how much it costs them to service their customers. Yeah. Because I think they ultimately realized the numbers were not numbering, right?
Yeah.
And even though they were selling, I think, pretty big ACV deals, pretty big deals to big enterprise customers.
Yeah.
But that's happened, I know, even with our founders, where they look at their AWS bill at the end of the month, they're like, oh my God.
Right.
That was way more than we thought, because maybe we signed on a customer who then had however many thousands of records that we were trying to, run through or whatever, right? And so I guess, do you have any stories or experiences with that? Is this something you commonly see? Is this something you experienced?
Oh, 100%. And so first of all, before I dive into, my personal anecdotes on it, of which I have maybe a litany, but it's so understandable in the early stage when I don't want to say take a hit on making a customer successful, but those first few customers are so valuable, right? You need that traction. I mean, you all at Workbench understand that quite well. And so you need those customers to then be successful, so that word of mouth starts, so that all the positive momentum things start from there, the learnings that you get. So in the beginning, you might not have that margin profile that you will ultimately want to get to.
Yeah, almost no seed companies
and
do.
no seed company is.
Yeah.
And that is expected.
And even at the Series A, right? Like,
Yes.
I would say
Yes.
really just to be aware of it. And I know that's the advice
Exactly.
you've given
Yes.
founders. Yeah.
Just know what it is. Just understand what your margin is, understand what a margin is, understand where it is, and understand where maybe, there's a lot of companies that have public company comps. Understand where the public company comps are, or understand where you want to get to. Have a narrative to what that's going to look like. So first there's that. But once we start to talk about getting into more of the scale up stage, where you do care more about the margin per customer, absolutely, I have seen some remarkable stories there. And what's interesting is that a lot of them, so back to the AWS example, you have a customer that brings on a lot more data or a lot more records than you expected. And all of a sudden, you're kind of trying to guesstimate what your margin is for that specific customer. In this particular instance, we didn't yet have our AWS instances tagged to try to kind of track that more granularly. It a lot of times will come down to how you think about your pricing structure and the units that move the needle on your margin. Pricing is a really, really rough science. It's art, it's science, it's a lot of different things. So I don't want to, poo-poo it, but one of the many items that should be looked at is going to be what is going to be the margin on these dollars that come in, and what unit is going to be sort of moving the lever on that from a profitability standpoint. So I don't know if that answers that question. I can give more specific examples, but
I guess the question I would even ask you is, do you think most founders are even aware of these things at seed or even Series A? Like, I'm just curious, and you've advised lots of companies, you've spoken to lots of companies.
I think if you're a repeat founder, you maybe know because you have been beaten up for it before, right? Or maybe there's very few and far between where you have somebody on your board who already is kind of reading you the religious text of, financial fluency at the seed or at the A, which may be a little bit early, but maybe that's their investing style. Generally not. And what is sometimes I think a little bit difficult for founders to do then is to say, well, I don't know what I don't know. And you're getting so much advice. And a lot of it at that stage is going to be on, rightly so, on go-to-market, on building that awareness, on making sure that your customers aren't happy, on making sure you have a product that works. And it's not always going to be on this side of the fence. And recently it's become more important. And I think that it's a healthy thing to at least understand what these metrics are, even if you don't have like the perfect profile for them yet.
Totally. Okay, awesome. I know we skipped straight into like the levers of sales and marketing, which I thought was just like a good example to say, hey, look, this is what a great finance leader could be a thought partner with you on to a founder who, again, might not have done this before and who might not even know the right questions to ask, right? So I think a seasoned, honestly, like a finance leader can help push on these different levers. Are there any other levers that you think are interesting, or maybe they're just like are unexpected that founders are like, oh, I didn't think about it like that?
So when I think about the cost structure of a company generally, there's the cost of the product, which we talked about. That's that goes into the gross margin. There's your sales and marketing costs. There's all your services costs. We could spend probably a whole session talking about all the nuances of services. So much time is spent on, especially in the enterprise, how much should we white glove? How much should we automate? How do we think about this over time? How much do we offshore?
Totally. And those they all break down differently.
They all break down differently. It all depends on your customers. It all depends on, what kind of margins you're kind of pulling in. One interesting side note there, and I'm going on a tangent, but Salesforce even at some point, it might even now, which is, obviously the most at-scale tech company that you're going to see with all the public filings, their services margins were negative for a while, very slightly negative. And we're talking about, as a percentage of their total revenue, something in the single digits that is services. But they make that decision to take that hit because it allows them to continue to be consultative and to stay in front of the customers. And then upon renewal time or for upsell moments or whatever it is, you're in a good position. So it's kind of almost like playing, I don't want to say it's playing defense. It's like offense and defense. It's just staying on the field. So I think that that's actually an interesting side note when we talk about the services costs.
And it's just that numbers don't always tell the whole story, or there's maybe a reason for the numbers, right?
100%. By the way, the numbers, and that's the thing that's great about numbers. Numbers are never lying. However, you need to make sure that you have the correct qualitative rationale around them. So the margin is negative, right? Unless there's some gross miscalculation, but this is a large public company, most likely not. The margin is negative. However, the why is what really matters, right? So that's kind of a side note there. So the services, there's the sales and marketing costs, and then there's the research and development costs. There's the engineering costs, and the question is, how much do you invest in the sort of core infrastructure of your product versus continuing to build on the roadmap? That's a constant juggle back and forth.
Totally. It's so hard.
And that's a very difficult one to answer. And certainly from there's a lot of folks who have asked, what are good metrics to use for, engineers and their output?
Yeah, because it's almost easier in sales and marketing, right? Like I feel like the benchmarks for sales and marketing are benchmarked, right?
I mean, there's top line.
Yes.
Like you're either getting sales and everyone's then crushing it in sales and marketing, or you're not getting sales. And then, then you have this sort of Cheshire cat moment of, is it sales or is it marketing? And it's everyone right, in that situation.
Yeah, but what do you do for R&D, right?
So for R&D, there's a lot of, do you think about, lines of code that engineers put out? I think that's silly. I think we all know that it's not about quantity, it's about quality, or maybe it is about quantity. You have to determine that for your own company. But that's a very difficult one to look at. Usually you look at it, by the way, if you absolutely must, look at it as a percentage of your top line. So I would look at, larger comps and say, as a percentage of revenue, generally you see R&D at like 40% of their revenue. And so over time, maybe you try to skew to that. Depends on your industry. That's a tough one. And then the last one is G&A. And so G&A is a funny one because it feels like the corporate back office-y thing. And so many founders are like, oh, if we could just not have that, that would be great.
Yeah.
Bringing in a finance leader sometimes just doesn't feel good, or being a people leader. They don't like those because it sounds administrative, right?
It needs a rebrand for sure.
Oh, it needs a big rebrand. Absolutely, it does. I think, and I think that's part of, why we're having this conversation, right? Is because if you have somebody or you have folks in that, let me say another thing. At a startup, every single person needs to be, strategic is the wrong word for it, but everyone needs to be doing more than checking a box.
Mm-hmm.
I mean, otherwise you shouldn't be at a startup, right? And so even when you think about the finance and the people functions and the legal functions and everything that falls into G&A, these are folks who should be thinking about how do I best help the company, and not just how do I, from a finance standpoint, how do I close the books? That will help the company. It absolutely has to get done. But we're talking about finance helping with, the quantitative side of the company's overall utility function, right? Like that's more
and qualitative.
Yes, and helping to craft the narrative.
Exactly.
Right. Around
I think
the numbers.
that's what a really phenomenal VP of finance should be able to do.
I think that
not just close the books, which is like misnomer.
Exactly. You do need to close the books.
Yes.
By the way, close them. Get it done. File your taxes. Do those things. But if you have somebody who does just those things, and I don't say just, they are important, then you don't have the right person in that seat.
Yeah.
Especially if you're at an earlier stage. Yeah. If you're sub, 50 million in top line and that's what the person is doing, you've got the wrong person in the seat.
Yeah. Well, let's maybe just go through the punch list of the top, the key metrics that you're like, every founder, even at an early stage, you should just know about. Maybe you're not hitting those numbers yet. Maybe we're still a ways away, but maybe we can go through them and maybe talk through some of the ahas or the gotchas that you sometimes see founders struggle with. So maybe the first one is top line. I know you've already talked about it a number of times.
So important.
Yeah.
So important. You need to have a thing that people want to buy. You need to have revenue. You need to have, and not just revenue, right? So would it be helpful if I talk very quickly about GAAP versus non-GAAP? So when you think about top line, especially at the early stage, a lot of times you're going to talk about MRR or ARR, and that's monthly recurring revenue or annual recurring revenue. And so that is non-GAAP. What does that mean? So GAAP is an acronym, stands for Generally Accepted Accounting Principles. And what that means is that there's a lot of very stodgy rules that govern how you put those numbers on a page. So when I say something like GAAP revenue, that means that there are very specific governances around how that number is calculated. And so what you'll see a lot of times with something that is GAAP revenue is that it will sometimes be backward looking. So if you sign a contract, it's $120K. Very simplistically, you're going to be recognizing about $10K of revenue a month. If you just sign that contract and it's the end of the year, you're only going to get, a little bit of that revenue in your top line. That's why you have your annual recurring revenue calculation. That gives you that helps you to understand the full scale and the full value of the business. And that is non-GAAP, meaning it is not governed by auditors. E&Y doesn't go in and audit your ARR numbers. However, investors want to see it because they want to understand the scale of your business, the repeatability of your revenue, which we can talk about also. And they might have specific ways that they look at it. But generally speaking, it's the value of the contracts that you have signed. And they have to be recurring. So I know you and I have talked about this before, but when you sign a contract, you have to make sure if it's annual recurring, if you're an enterprise, a lot of times you'll have 12 to 36-month contracts. In that case, your ARR. If you have contracts that are 12 months or sometimes less, then you might look at MRR. It really depends on your own kind of the nuances of your business. The thing that I would look at there is that contract committed to over the course of that period? Are there any terminations for convenience? And I can say that 12 times because it is so, 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 so important.
I feel like this is like the big gotcha.
This is the gotcha.
That people don't talk about enough.
No. And, that's where having somebody who is, once you get to the stage where you're bringing legal in-house, even if you actually have your legal not in-house.
They should know this. And they should really press you on this.
Exactly. That's why you want to have quality legal. That's why, again, G&A needs a rebrand. I think, those roles matter.
Yeah. But I guess sometimes, companies give on that. And maybe you can, give you the platform to explain it, but they give on that because they're early and they feel like they don't have the negotiating power against an enterprise, right? So maybe you just talk about what this term is. Yeah. So termination for convenience is a term inside the commercial contract with a customer that says that for any reason, sometimes there's sort of behind the scenes terminations for convenience. But in general, it's for any reason we can terminate this contract at our discretion. Sometimes they will edit that to say, if there is a change in our business, then we can terminate. Well, what does that mean? Yeah. That's qualitative. So anything that is a qualitative way for them to walk away from the contract is a termination for convenience. Right. And the reason why that's a problem is because when investors look to assess your business, they want to understand, how much revenue do you have and how well can I underwrite that revenue? And so they want to see that revenue is going to continue to exist, that it's going to recur. By definition, if you have a termination for convenience, it may cease to exist. And that matters at the time of raising rounds. It matters at the time of M&A. Where they will dig through, in the data room, they will dig through all your commercial contracts. And if they see that some contracts have a termination for convenience, remember when you're purchased in an M&A transaction, it is as a multiple of your top line. They will then discount the top line if they see a termination for convenience. Yeah. That's a problem. Yeah, and I think at seed, right? I think founders just think, oh my gosh, I don't even know if I can negotiate this way, because it's usually on your customer's paper, right? And they obviously include that, right? Because they do want an out. So do you have any tips for founders? I mean, is this just something that like as you get more and more mature, you will be able to negotiate out of it? Do you see some counter negotiation founders should do? Because I think a lot of them, again, in the early days, like you just got to close customers, right? So you think, well, it's a give.
Yes.
Like, what's the worst that could happen?
Right. And especially in procurement. I mean, that negotiation is so tough.
It's like so hard. They really want that, right?
They put you through your paces. Right. And so maybe at the beginning with customer 1 or customer 2, maybe you really, really do. You're willing to offer all sorts of discounts. They don't really care, right? If you're going from like 80K to 50K or like 150K to 100K, it's still small dollars for them. Right. So even if that doesn't work, you might have to just accept that. Yeah. Even if you try to get your stakeholder to get in your corner and say, hey, here's why this is really important for me not to have this. And even if that stakeholder tries, procurement might just, and every company is different, procurement could just steamroll them and say, no, we are doing this. And that's the risk that we're taking as the first or second customer. After that, though, I'd really try to put your foot down and say, hey, we've got great XYZ customers. They're successful. Look at what they're doing. Take their use cases, put them on every single PowerPoint that you have or whatever cooler Mac version of PowerPoint keynote you have. Excel land. And try to convince them that this is just something that won't fly, right? That's going to be your stance to negotiation.
I feel like that is the TLDR for this episode, right? Like if you're a founder, you know, you just might, again, not really realize the implications for this.
Right. Down the road,
right?
Down the road.
Okay, awesome. So that's top line. You also mentioned funnel and funnel conversion. And people talk about funnel conversion a lot. I think a lot of founders are just like, yeah, we convert the funnel, right? I mean, can you just talk a little bit about that?
Yeah. I mean, so one of the other things that you're going to want to see when you're looking at a company and you're assessing it is in the sales and marketing spend that they have, or if it's in the really early stage, they might not even have sales and marketing spend really yet, but do they have leads that are then reasonably moving through that whole funnel process? They're moving through the funnel in order to underwrite what their future revenues are going to look like. Because when you're fundraising and you're looking at a model can be crap, right? A model can be many, many tabs and it can be absolute crap. What really matters is, and it should work, but the art of it is making sure that the inputs and the assumptions are ones that potential investors or your board are in agreement with. And so one of the big ones there is, what is my future top line going to look like? Because you can't invest in a company and put into that expense structure if you can't underwrite what's going to happen at the top line. And so the way that you do that is by, in any way that you can, show traction in the top of funnel that you have. So in the leads that you're getting, and say, hey, normally I'm seeing this many leads. Here's how I'm seeing them progress through the different stages of the sales cycle. Here's the amount of months or days, depending on how lucky you are, amount of months that it takes for them to get from, top to mid funnel and from mid funnel to bottom of funnel. Analyzing that funnel and really understanding it is a really, really important part of getting investors comfortable, getting yourself comfortable, honestly, on the kind of ongoing nature of your business. And there's really two things there, right? You want to understand what new revenue is coming in through this funnel conversion that you're tracking so closely. But then you want to also, and this goes back to the kind of customers getting comfortable with you part, is the retention, right? Do those customers then also stick around?
Totally.
And that also helps you in underwriting the future revenues.
Yeah.
So from a finance lens, a lot of the metrics that are looked at, generally speaking, and not just finance lens, let's say like a corporate lens, right, are generally showing present day. Here's what is happening now, or here's what happened before, which is good to understand. But a lot of times, especially at the early stages, you want to look at what's going to happen in the future. And really the only way that you can truly de-risk and underwrite the future is by looking at what's happening in your funnel. Yeah. Because that's revenue that hasn't happened yet.
No.
Right?
Yeah. And, the thing I would ask you is how accurate are these, especially seed stage funnels versus even Series A?
Yeah.
Right?
Yeah.
Because seed might be just a bunch of intros you got from your investor, right?
Right.
And is that truly repeatable?
Right.
So at what point do you really say, okay, this funnel conversion is like legit?
Yeah, like this is
legit
a real
data.
This is happening.
Yeah.
And it's funny because you will see even into the much later stages in companies that there's always a reason why in a specific quarter things looked the way they did. You're always trying to qualitatively couch it. So there's
and actually different quarters could look very different, right?
Different quarters could look different.
Of businesses.
Exactly.
Yeah.
Exactly. But kind of going back into the seed stage, definitely that funnel is going to look a little funky. I mean, are you even tracking at that point? Aren't you trying to find product market fit?
Right.
So at that point, do that. Find product market fit. Make sure that you are selling a thing that someone is buying and figure out who that person is and then try to go at more of those people, right? That's when you start to put the leads in. Then you start to get to the A and then you start to see things hopefully starting to convert. Look, you're not going to say, this is truth with a capital T. This is the way conversion works for my company always. But being able to say, here's the pattern I'm seeing.
All right.
Here's how I think reasonably this is going to progress over time. Here are the reasons why I think that.
Yeah.
That's a very reasonable story.
Yeah, absolutely.
Right? And that's how fundraising gets done.
Yeah. Another proxy I heard recently was actually just looking at sales cycle length. At the very earliest of days.
Yes.
Just being like, okay, did it take us 9 months to close this customer?
Right.
Or did it take us 6, right? Because in your early stage, like, again, there's a lot of, whether it's even stage 1, stage 3, so, you're like, bah.
Yeah.
But end to end, you can say this is how long it took to close.
Right.
As a proxy, as a very rough proxy.
Just to start.
Yeah.
And of course, in different industries, it'll be different. If you're selling into a bank, you might be 85 years old before you close that.
Exactly.
Right. But no, it'll be closer to call it a year or 2 years. Right. Yeah. But one thing that is interesting, though, about the funnel is that one sort of tidbit that I'd add in there is that making sure that your different stages have objective entry and exit criteria is really important.
And sticking with them.
And sticking with it. Because if you are redefined, the worst thing that you can do, obviously we're all reasonable people, startups evolve, companies evolve. You might have to change the way that you think about the definition of your metrics for some very reasonable reasons. Yeah. And you should just be open about that with your board, right, if you do that, and your investors. But generally speaking, if you start to change the goalposts, then you're losing.
And how you qualify things, right?
And you're qualifying everything.
So you're saying stage 1 to stage 2, you should be very
clear on what that is. Objective entry and exit criteria, even in enterprise sales cycles where things can be circular. Because a new stakeholder just walked into the room. And oh crap, we're back at stage 1 again.
Yes.
No, you don't have to move yourself back there.
Yes.
Keep yourself where you are. But yes, it's going to be circular. Make the best guess you possibly can. If you have enough stakeholders that already in the late stage, keep it there. Yeah. Don't do wishy-washy things because your metrics should reflect what you know qualitatively to be true. If you know that this is a contract that has been, or a customer that you've been working on for a long time, and you think that they're pretty close to closing, then that's what you should see in your data. Yeah. Your data should not be some other esoteric thing.
Yeah. That's so helpful. That's so helpful. And the going back to your point, and you've touched on it, but the other, I would say, thing that is perhaps in the control of a seed stage company is retention. Yeah. Right. And that is, it's like if you worked 85 years to close that bank, you better work really hard to retain them and keep them.
Yes.
And I will say, you know, I think phenomenal founders, are very sales driven. Yes. And so they are super excited. They go and close a customer, they hit the gong, and they immediately go back to find the next customer.
Right.
And really CS or post-sales or whatever you want to call it is often relegated as like the second, just like a second tier thing. I was like, oh, well, they'll just be successful.
Kick it over to them,
And the reality is like, I say like, you need to put as much into whatever you did to close them on sales as you need to put
into making them
successful, right? Yes. So maybe if you can talk about retention as maybe as the metric and maybe what messes people up here the most.
Yeah.
But then any other, tips or tricks or pro tips here.
Yeah. So retention obviously matters so much because the other side of retention is that your upsell sales are a lot less expensive than new logo sales. New logo sales are they take a long time. They're very resource intensive, and therefore they are very expensive, and commissions are also expensive. The best checks that you write if you're getting, really great contracts, but they are expensive. So you want your customers to be around because upsells are less expensive. Happy customers mean hopefully more happy customers as you put them in front of your prospects. There's a lot of good stuff that comes out of retention. It's a really important probably after, what is the scale of your business? What is your ARR? Retention is probably second most important,
I think it's
right?
huge. And especially I think at the Series A.
Oh, for sure.
That is actually the metric that investors are really digging in on,
Right.
both the net and the gross. So maybe you can talk about the difference between net and gross, maybe for founders
for
who are
sure.
not aware.
So, and again, right, your investors want to underwrite the future growth of your business. And so if they see a stable customer base that stays with you and that grows, then it makes it so much easier for them to go back to their partners and say, hey, we should really invest in this company. So, there's that a piece of it. So let's talk about retention then specifically. So there's two components for net retention, right? So there's the gross retention piece, which is, a customer signs on with you at the end of a year, if you have kind of annual contracts. Are they still with you? Are they renewing? Or have they turned, right? So $100 on day one, is it still $100? Or maybe it goes down to like $95 or something at the end of the year. So that if it's 95, it's 95% gross retention. Net retention is, we have those same base of customers that signed on. Did they not only stay with us, but did they buy more from us? Just that base. So it excludes new logo sales. And so that $100, did it then turn into, from that cohort, 110, 120, 130? And if that's the case, then you have 120% net retention, 130%, which is 120%, 130% is best in class. And the reason, again, why these are so important is because even if you did nothing, what that tells you is that your business can grow 20, 30%, right? And as long as you continue to make customers successful, that's amazing. So then you go out there and you invest more in sales and marketing to get more new logo sales, absolutely, because you want to continue to feed that pipeline of putting customers, on your product and then upselling them. And so your funnel at the end of the day, it's not so much just a funnel, it's that bow tie, right, that everybody talks about, where you have your leads that go down into, getting your new logo sales that then grow as they upsell over time. So that's the healthiest thing that you could do for your business.
Yeah, it's interesting your point about, even if you did nothing, they would expand. I would push
with net retention, right? With healthy, consistent net retention.
Yeah. But I think there's a lot that goes
you don't
into
know that yet.
But there's a lot that goes into upselling, I think, right?
Yes.
And I think this also goes into like maybe even some of the pricing or packaging choices you make at seed.
Totally.
Right? Like that could affect whether or not you can upsell a customer.
Agreed.
Do you see that happening where like, again, maybe the choice you made on how you packaged it later means like a customer's like, honestly, I don't have any more room or I don't have any desire to upsell? Yeah.
And by the way, absolutely. And one thing, when I say do nothing and you'll grow 20 to 30%, I mean, no, you can not have any more new logo sales. Yes, you absolutely have to do something. Yeah. You can't just say, all right, guys, we're done
good.
here.
Let's go.
Let's get drinks on me.
Yeah.
No, so you do definitely have to do a lot of things. But, to the question that you asked on
pricing and packaging.
Thank you.
Yeah.
So, yes. So the decisions that you make in the way that you structure your pricing can or cannot make it easier or harder for a customer to upsell with you organically. And so sometimes you have pricing that is, kind of what they call like enterprise license pricing, which is here's the price for, this many terabytes of data to be ingested into my product. And we will upsell when you put more data into the product. Well, if the customer doesn't put more data into the product, but they're doing a lot of things with that data, then you don't have as easy of a motion.
That's right.
For the team to come in and say, hey, we really think that upon renewal, we should be 20% higher because we are so useful to you. So really thinking about the pricing and packaging in a way that allows the team to elegantly and easily upsell. So either that's going to be additional modules in your product, or that's going to be, some sort of volume unit that the customer is using. There should be something. It used to be seats. Maybe it is seats again, but I think that there's been a little bit of back and forth on whether or not that's the best way to price.
Yeah. Seats has been tough, right? Because sometimes they're just, if your customers are not growing, or if they actually contract,
we've seen that.
Then you too will contract.
Then you too contract, and then it's very painful.
Yeah.
And you didn't expect that contraction to happen.
Yeah. And there's going to be interesting, I think, new types of pricing now with AI, and it feels back to usage, which for a while usage was not. People were not loving usage. Finance leaders are not loving usage because it's hard to predict or forecast, right?
You have to build in like a consumption-based model, which is what you're talking about, like what Snowflake has. You have to build an entire team of like an entire ecosystem within your company just to help you to predict your top line. Because that is so important.
So what do you think is going to happen now with all this AI stuff?
I think
it's going back to that, right?
You know what though? Snowflake had to do some of the hard work of training folks on that pricing model. And one of the things that I was also going to say in pricing and packaging is that you want it to have an organic upsell motion, but you also want it to be simple enough that the customer doesn't have to do, high-level calculus to try to understand it.
Right.
However, if they've already been trained to do some of that calculus, then you could just ride on the coattails.
Yeah.
And so consumption-based pricing is starting to become, and volume-based pricing is becoming, or is already, a lot more acceptable. And so you're seeing customers do it. The thing is, again, because it is so important for you to be able to forecast your top line on your company, it does mean that you're going to have to devote a lot more resources to figuring out what that top line is going to look like, because it's harder to forecast.
Totally. Okay, amazing.
Yeah.
It's already an hour, just wild.
Really?
Yes,
Great.
I know. And I was like, I feel like we covered most things. There's probably even more that we could do a whole masterclass on. But let me ask you, I guess, the last 3 questions, and then I might go back to one question I had in the beginning. So if you were to fast forward through this episode, what is that one punchy TLDR that you think founders should walk away with?
I mean, the big TLDR to me is having the ability to be able to underwrite and have confidence in where your company is going from a top line perspective. And if you're able to really have that confidence, more or less, right? I mean, obviously as a startup, things are going to be imperfect, but kind of understanding what is the momentum in my business? What are the tailwinds? Where am I going? Also then helps you to invest more easily into the expense structure of your business, and into sort of the future and the eventual exit of your company. So then, another big takeaway I think is, as you're going through your commercial contracts and through those negotiations, one of the gotchas that comes at you much later on in the life cycle is having a termination for convenience in your contract. Investors want to underwrite revenue that is committed, revenue that is recurring. And by definition, when you have a termination for convenience, even it's with what they call a backdoor termination for convenience, which is, if the customer has business changes that require it to terminate, it can, then that contract, the value of that contract gets discounted from your top line. So something to be very careful about in the early days.
And try to not have that.
Try not to have that. If you need to have it for your first or second customer because you need to get someone going and you need to start getting that momentum, there are gives that you give.
Yeah.
But over time, that should not be status quo.
Awesome. Who do you think we should interview at some point?
I think that an incredible public company CFO, if you can get him on this podcast, is Michael Gordon, who is the former CFO and COO at MongoDB.
Okay, amazing.
Super thoughtful,
amazing. Really,
really smart guy. I only spoke to him personally one time on a Zoom for half an hour, but it was one of the most useful 30-minute segments of my career.
Oh my gosh, that's amazing.
Where he essentially was helping me to figure out, as you were thinking about fundraising narratives, here's how you do it.
Wow.
And it's amazing. So if you could get him,
we're going to bring
awesome.
him back. I'm going to bring you and him back.
I'd be honored. I'm actually at a dinner that he's at later today.
Okay,
but
awesome. We'll slide that in. And how can people follow you online or wherever you go?
Sure. So I'm on LinkedIn under my name, which is I guess how it normally goes. Edit that out, please. under someone else's name. And then I'm also on Twitter. So that's another place where I'm active.
Amazing. Well, thank you so much, Michaela.
Jess, thank you so much.
So fun.